You walk into your local bank, hand over your hard-earned money, and assume it's being kept safe. That's the deal, right? You trust them with your paycheck, your savings, maybe even your future. But what if I told you that some of the most important things banks do with your money happen quietly in ways most customers never think about? And that understanding this changes how you should use the banking system entirely. I'm Dan, and today I want to walk you through 5 financial realities that banks rarely explain clearly. This isn't conspiracy, and it's not anti-bank. It's simply how the system works and how this may affect you without you even noticing. Let's start with the first reality because it surprises almost everyone. When you deposit money into a savings account, that money doesn't just sit there waiting for you, it's immediately put to work. Banks lend it out, mortgages, car loans, credit cards, often at interest rates many times higher than what they pay you. If you deposit $1,000 into a savings account, earning 0.5%, you'll make about $5 in a year. Meanwhile, the bank may lend that same money to someone else at 10, 15, or even 20% interest. They might earn $100 or more from your deposit while you earn 5. That difference isn't an accident. It's the core of their business model, and it goes deeper. Through something called fractional reserve banking, banks aren't required to keep all of your money available at once. Typically, they only need to hold a small fraction, often around 10% as reserves. The rest can be loaned out almost immediately. So when you see $1,000 in your account, only a portion of that is actually sitting at the bank. The rest is already out in the economy, generating profit for the institution. This system works because banks rely on predictability. They know most people won't withdraw all their money at the same time. As long as withdrawals remain normal, everything runs smoothly. But it's important to understand that your savings account isn't a storage locker. It's raw material. That brings us to the second reality banks don't emphasize. Promotional rates are designed to attract you, not to help you long-term. 0% APR offers, high-yield savings accounts, cashback bonuses. They look generous, but they almost always come with conditions and expiration dates. That 0% credit card rate might last 12 months, then quietly jump to 25%. That high-yield savings account might require a large minimum balance or impose fees if your balance dips. Banks know many people won't track these details closely. Life gets busy, deadlines pass, and suddenly the product you signed up for is far more expensive than you expected. This isn't because people are careless, it's because banks design these offers around human behavior. They assume you'll prioritize work, family, and health over monitoring fine print, and they're usually right. The practical takeaway is simple. Promotional rates are temporary tools, not permanent solutions. If you use them, plan your exit before you sign up. Set reminders. Decide in advance whether you'll pay off the balance or switch products. The benefit only exists if you stay ahead of the timeline. The third reality is one of the most frustrating, especially if you don't have much money yet. Free bank accounts are rarely free. Many checking and savings accounts advertised as free quietly include requirements. Direct deposit minimums, transaction limits, balance thresholds, fees for paper statements, overdraft penalties that trigger faster than you expect. A checking account that looks free on day one can cost $10 or $20 a month once fees creep in. Over a year, that's hundreds of dollars, often paid by the people least able to afford it. This is why reading account terms matters more than the headline. Ask direct questions before opening an account. What happens if your balance drops? Are there monthly fees? What triggers overdraft charges? How much are they? Banks won't volunteer this information unless you ask, but they will answer if you do. Now let's talk about a reality that explains why banking feels unfair for so many people. The more money you have, the better banks treat you. If you're struggling financially and apply for a loan, you're often offered high interest rates because you're seen as risky. But if you already have assets, banks compete for your business. They waive fees, offer better rates. Sometimes they'll even pay you bonuses just for bringing your money over. This applies beyond loans. Wealthy customers often get free checking, dedicated advisors, and preferential treatment. Meanwhile, people living paycheck to paycheck may pay monthly fees just to access basic banking services. From the bank's perspective, this makes sense. Wealthy customers are profitable and low risk. But from the customer's perspective, it creates a system where those who need the most support often pay the most. Understanding this isn't about resentment, it's about strategy. It helps you decide where to bank, which services are worth using, and when it makes sense to shop around rather than staying loyal. Now we get to the fifth and arguably most important: reality. Banks benefit when customers don't fully understand how money works. This doesn't mean banks are hiding secret documents. It means there's very little incentive for them to educate customers deeply. Informed customers negotiate fees, switch products, avoid unnecessary interest, ask uncomfortable questions. From a business standpoint, that reduces profit. Think about how much financial education you received in school. Most people learn advanced math but never learn how interest compounds, how fees accumulate, or how to compare financial products properly. That knowledge gap isn't actively fixed because it doesn't need to be. Banks also rely heavily on inertia. Once you open an account somewhere, they know you're unlikely to switch unless something goes seriously wrong. That's why customer acquisition is prioritized over long-term education. But here's the part many people miss. You have more leverage than you think. If you've been a reliable customer, banks will often waive fees or adjust terms if you ask. They won't advertise this, but retention matters to them. A short phone call can sometimes save you hundreds of dollars per year. Understanding how banks operate doesn't mean avoiding them. Banks provide essential services. The goal is to use them deliberately, not passively. Choose accounts with transparent fees. Track promotional deadlines. Ask questions. Negotiate when possible. Banks are businesses. They're not villains and they're not advisors. They sell products. Your job is to understand what you're buying and whether it actually serves your interests. Here's the most important takeaway. Staying financially informed doesn't require obsession or expertise. It requires curiosity. Read your statements. Question fees you don't understand. Don't accept explanations that feel vague or rushed. A few minutes of attention can save you thousands of dollars over time. The system isn't designed to make this obvious. But once you understand how it works, you stop feeling confused or behind. You start making decisions from clarity instead of assumption. And that's the difference between banking being something that quietly drains your money and something you use intentionally on your terms. If this video resonates with you, consider subscribing, and I will see you in the next one.